Now, the best way to understand and learn technical analysis is through examples and through real life cases. In this course, what we will focus on is to get real life examples and as many cases and examples as possible so that you are able to understand the technical analysis better, but at the same time, it should also help you pass the exam. Now, it should also help you foresee the questions and their possible answers for the exam perspective. So we'll give you theoretical from exam perspective as well as practical examples, how they relate to the practical world from application perspective, from a trader's perspective. So let's start with the basics here. Now this is a particular graph or a plot of prices. These you can see are candlesticks. Green or blue candlesticks are where the prices have increased, or rather the closing price was higher than the ending price, or starting opening price rather. Red candlesticks are where your ending price were lower than your opening price. So you can obviously see red, where you see predominantly red area. This area is where the prices have decreased. Where you see predominantly blue or green area, this is where you will see prices increasing. And where you see them being almost equal in number and strength, this is your neutral zone or trending zone or sideways trending zone. Here you will see the red and blue charts, candlesticks are almost equal in number and equal in strength. Right? The length or height of these candlesticks denote the strength of them or the movement within this. So when this red candlestick here, this red candlestick here denotes that the difference between starting or opening and closing price was considerably higher, vast. Right? So what does it tell us? If you look at this blue line, right, this long blue line, you can see visually that the prices are increasing. You don't need technical analysis to tell you that. Right? This is just us clearing the formalities, the terminologies. So you can see this blue line which says the trend is increasing on a longer period of time. How to calculate this line, how to exactly formulate this line is something we'll see in the coming part. But at the same time, you also see these smaller trends, temporary trends, ripples. So longer line, this trend is over a tide. This trend, small trend, is over a ripple, right? Smaller time period. So these are shorter trends, and obviously, as you can see, they are reversing. Short trend is increasing, turning and becoming a uptrend. This downtrend is becoming uptrend. Uptrend is reversing and becoming sideways. Again, it's an uptrend. These smaller trends reverse earlier than the large. Right? So this is something you will have to keep in mind. This is the trend line, as they are called. This line that we have traced here, this is the large blue line. This is the trend line. Right? Let's move on to some more basics. Now, this is the core part of our trend analysis. Very important terminologies. You have to get those terminologies right and clear. Until you get those concepts clear, you will not be able to understand or relate to the part that we are going to cover in the remaining chapters very efficiently or very effectively. So what you have to keep in mind, some terminologies, as I had mentioned, you know the candlesticks, how to read them. Now in terms of trend, you will notice the prices are increasing, they reach a highest point, then decrease, reach a lowest point, then increase again. So there are some highest points here over this particular graph area, and then there are some lower points here. This is a real graph, right? This is not an academic exercise. You would notice this is a 6 months period graph. This is 2020 May. So 6 months starting from 24th November. So you can probably interpret the period as well. These are the current levels of this particular stock or index. I'm not going to disclose the name of this index or stock wherever you're looking at, but these are real life, real situations. This is how the prices look. The points which are at the lowest here when the trend reverses, these are called troughs. These are the troughs which are at the bottom. So these arrows should help you. Trough. It's like a wave in an ocean or a sine wave. The lowest point in a wave is called trough. Notice that this trough level is higher than this one or even this one. So it's not the absolute lowest point in a particular period, but it's more of a temporary lowest point in a particular trend, right? So this is a downward trend. This is the lowest point here, and then it increases again. Right? So similarly, there are peaks, which as you can see are the topmost point in a trend. So these are peaks, like just like in a wave, and they can have different heights. Peak can have different values over a given period of time. So these are the peaks. What you see here is, this is an important area. Now prices are increasing more or less in this range. Of course, not in a straight line, but in a movement, there are movements, there are forces pulling that prices in both directions. But more or less, these are increasing over this range. But prices were not able to cross this point. Prices increased, then they went down, increased again, but again they did not cross this line. Again here, increased again, but did not cross this line. This is an area where prices are not rise beyond or cross this point. They are facing a resistance of some sort to cross this price barrier. It's a mental price barrier. There's no regulatory barrier or something. It's just a mental price barrier in the minds of traders. So this is called a resistance line. Right? This line over which the prices do not increase is called as a resistance line. Similarly, on the lower side, even though prices have declined, they are not crossing this particular point. Right? As soon as they touch this part, they increase again. They touch this line, they touch this area, this price zone, and they increase again. Right? So this is a sort of a support for the prices, below which the prices do not drop. So this blue line is called as a support line. Right? Resistance is always at the top, support is always at the bottom. Another point that you would have noticed is quite obvious is it's not a single price point. And in this particular case, the resistance, upper side of the resistance is 15,429.72 points. But the prices have not always reached this point in reverse. They are around the range, right? Around the same point of the price point. This range is called as a resistance zone. This dotted line, slightly below the main dark line, the solid line resistance, is called resistance zone. Prices are reaching this area, this region, resistance zone, and then coming down. They are not touching this blue line every time, but somewhere between these solid line and dotted line. So that's called a resistance zone. Similarly, on the lower side, this area between dotted line and solid line is called a support zone. Prices are not always reaching this solid blue line, but they are reversing somewhere in this zone. Here, somewhere in this zone, somewhere in the support zone, almost touching the support zone. Right? So the peaks, resistance line, support line, trend line, they are not always a single point or a particular horizontal straight line. It usually is a zone, but that's just for our understanding. When we are drawing these resistance zone or support zone or other resistance lines and support lines, we will draw them as a single line. So this is something that we have to keep in mind. Now if I have to find out a trend here, as you can see, between this range, the trend is upward, right? So I can draw a line which is sloping upward, and that would be the trend. But in this region, you would see prices fluctuating between these zones, right? Between the resistance line and support line. So that is my trend, which is horizontal. In this case, my prices are not moving in a particular direction, but they are just trending horizontally in a neutral zone. Of course, this range is quite big for a particular security. It is between 14,200 and 15,400. So that's almost 1,200 points or in percentage terms, it's almost like 7 to 8% range between which the prices are fluctuating. But if you look at the time period, right, these are the months at the bottom. This is May and this is February. It's almost 4 months. The prices have moved only between this range, and this is the neutral range. Compared this to previous 2 months or 3 months, the prices have rose from just below 13,000, like we can call it as 12,800, to as high as 15,400. So that is close to 2,500 or 2,600 points over this 15,000 price point, current price point. So this is the trend level denoted by green line here. Now understanding these terminologies, will move on to understand some new terminologies and some more technical terms related to trend analysis. Now another point that we have to keep in mind related to this resistance and support levels is that these are kind of a psychological barriers, right? Why do these lines exist? Why do these well-defined zones exist? That is, from the psychology of a trader. Think of it from that way. Now a trader, when you're looking at this trend, it's easy to follow when the prices are going to reverse. On the high side, the trends is always easier to charts, and trends are always easier to figure out. But in the real time basis, it's really difficult. Suppose if you're standing at this particular region, right? You are here somewhere. How do you know whether you should enter? You've not entered the position for now. Then how do you know whether you should enter at this point? Do you think the price rise will continue because it has continued from here to here? And mind you, this is daily charts. These are almost 15 days, 2 weeks period. So at this point, how do you know whether you should enter here or wait till the prices reverse because it's nearing resistance zone, or it's reaching some invisible barriers after which the price will decrease? How would you know? So this resistance or support line exists because the traders want to take some mental support, to take some hints about the pricing. So when the prices are near this zone, the buying pressure for resistance, we're talking about resistance, so the buying pressures, people who are willing to buy at this zone would be more conscious because it's nearing some previous peak. And people who have already entered into a long position here would be willing to take book profits and close their positions. So there is an increased selling pressure here. And again, whatever applies to the uptrend or resistance also applies to the downtrend and support zone. It's just that it's the mirror image of what we're talking about, so we'll not repeat the stuff for same unless there is some difference. So these are mental cues. However, when support zone or resistance zone is broken, that's more of a psychological barrier. So when a resistance zone is broken and the price increase substantially and on a sustained basis over the support or the resistance line, the resistance line becomes a new support line, because that's a mental barrier. So that is something we have to keep in mind. Now, as we mentioned earlier, it's a zone. It's not a single specific point. How do we know where the reversal is going to happen, either on the uptrend or on the downtrend? There are certain methods called out for finding out this reversal or finding out these reversal points either in uptrend or downtrend. First of them is the Demark or Williams method. Now, obviously, these are two different people, Tom Demark and Larry Williams. They have both found a method or a template which is very similar, so we'll call them as Demark or Williams method. So what they do is they are looking for a point, either a peak or a trough, and they are looking at a close or a candlestick just to the left and right of it. So if we go back to our example here, now if we look at this trough, how to determine if this point is really a trough, right? If this is a bottom or this is a support, they will look at the candlestick to the left and right to it, if these prices either on a closing basis or at the day low basis are more than the closing of this particular candlestick, then we can see that this particular middle candlestick is a trough. Applies to peak as well. If these are lower than our peak, than our price point under consideration, the price points just on the previous day and next day, or previous hour and next hour, depending upon what is your scale, previous candlestick and next candlestick, if they are lower, then this is your peak. So this is your Williams or Damark method. Second method is percentage method. Again, this is very similar to Williams method, the previous method, but here we don't see just if they are lower or not. We put some barrier. They should be lower at least by a certain percentage. Usually that percentage is 1. So if we are talking about a peak, then the candlestick preceding and following that peak should be lower than that peak by at least 1%. In case of trough, it should be more by at least 1%. Then only we can say that this is a true peak or a true trough, and that is our percentage method. You can have different percentages, higher percentages as well, especially if the volatility is low. It's not a fixed number. Then the other method is Gann two-way swing method, or this person Gann has a really important contribution to technical analysis. So he has come up with some method to identify whether it's a peak or trough, to find a support point. Now by Gann swing method, a trough or a support point, a low bar is identified, just like we had in previous case, one of the low bars that we picked. So once that low bar is identified, we take two following days, right? Not just the preceding days, but the following days are in focus. So if these following days have higher highs than the low bar and at the same time higher lows, then that low bar is a support line. So for example, if you go back here, again this particular trough, it could be a support line because the two candlesticks, two bars following it have higher highs and also higher lows. So this is where we can say this is a support. This particular trough is also a support. Also the mirror exists for peak. If the next two bars or candlesticks have lower highs and lower lows, then we can say the peak is a support over there. Original method was using three trading days if you're looking at daily charts, but some people also use a variation with 2 trading days. So whatever we say for trough also applies for peak. So this is the Gann two-way swing method, right? Or 2-day swing method, whichever way you like to call it. Next is high volume method. Now again, it's very similar to our previous Gann 2-day method or two-way method, but the exception is we are looking for a support by higher volume. So there could be reversals that we had seen earlier, but they are true support points only when we see higher volume on the next days, right? In case of a trough, if we see higher volumes on the next day when your ending data or closing price is higher than our support point, then we can say this is a true support, and that's our high volume method. Now this is about our reversal points or methods to calculate reversal points and support or resistance zones. So now that we have understood the support and resistance and reversal points, what makes more sense for us to learn is how to make profit, how to trade using this information. So we look at the trading ranges. So we'll first look at some theory about it, and then we'll look at some examples, how they are applied in the real life. Let's understand the practicalities about trading in ranges or the neutral zone. Range trading is really difficult in most cases. First of all, to recognize that prices are trading in ranges. Right? As you had seen earlier, the range trading, the neutral zone movement happened for almost 4 months, and there was an up and down swing for as high as 7-8% from top to bottom or peak to trough. So it is difficult to recognize when the prices are going to move within a range, first of all. So it is difficult to enter and find opportunities to enter. Additionally, that what we have is operating cost. Now, in this case, we had a range of 7 to 8%, but often the neutral zone is much narrower, barely 2 to 3%. So, first of all, the full profit potential is low here. At the same time, by the time you realize that the trend is happening, or what needs to be done, what is your entry point and what should be your exit point, the prices have already moved. So we have operational cost, plus we have slippage, right? Slippage is the time taken to act on a identified opportunity. First, it takes time to realize the trends, then it takes time to identify the opportunity. Then before we can identify the opportunity, there is operational delay or operational cost, slippages. And because of these bound trading ranges, so again, this is not a particular price at which, or particular point at which price is going to reverse. It's usually going to be in the range. So again, it becomes a difficult to find when it is going to reverse and when it is going to continue, and when exactly you should exit. So, and because of this, it's also difficult to put an exit point even when you're using a stop loss. So you cannot be very specific, very particular about where you would put a stop loss. So in other words, that is your exit. Of course, there are methods to do that. There is something called as channel trading. Now again, channel trading is not really trading between the range or between that channel, but rather waiting for that channel to end. A channel is usually zone, two lines, a support line and a resistance line, but they are usually in upward or a downward fashion. We will talk about it in the future course, but let me just put it for our understanding here. So this is a channel. So let's say the prices are moving like this. So between this range, so this is our channel in the upward trend. It could also be in a downward trend. So here it's relatively easy to understand the price movements, and we also can have a breakout from this channel. That is when the prices come out of this support zone, or on the other side, out of this resistance zone. Profitable trading is relatively easier at this point, or rather, most of the cases at this point, and this point when you have recognized that the breakout has happened. So when the breakout happens, it is easier. We can pretty easily understand when the breakout has happened and take positions. The flip side of it is, or rather a supporting argument here is, previous resistance line when the prices were not able to cross it, once the prices break out, becomes the new support line. So you can put your exit points, right, or what are they called, close orders, in this particular new support line, or the downward side new resistance line. There are methods to recognize this, something called as Donchian breakout method. We'll look at it sometime. The point here is to understand is the Donchian breakout method uses a 4-week breakout system. So it is obviously over 4 weeks period, which is a very long and strong point. So the longer the period, longer the trend occurs, the stronger it is going to be. So the Donchian method is a very, very strong indicator. The calculation for stop loss is relatively easier. The calculation is, the rule of thumb is to buy when the highest high over the past 4 weeks is broken, right? So highest high, if we go to this example, in the past 4 weeks, probably this peak was somewhere here. So buy call will come only when this price is crossed, right? This price is crossed. So this is a true indicator. It has crossed the previous barrier. So this is my buy point. And sell or stop loss when, on the other hand, on the lower side, if you have to sell this thing, or if you have to enter in the sell side, this is, let's say, the lowest low over the past 4 weeks, this particular point. So we will enter into a short position or a sell position when this particular point, let's say prices move from here and cross this point. Then only when this particular low is crossed, then we will enter into a short side or a sell order. So this is why trading in ranges or breakout trading.